All right, it is October and the September numbers for the Vancouver real estate market are out. And we're going to share some stories of specific clients that we're working with right now and some real life examples and just some insights that can help you potentially make your next moves here. So there's a ton of news in the real estate market and we're here to state the facts and offer perspective around them. If this is your first time on the channel and you want to know everything there is about real estate and living in Vancouver, subscribe below. Tap the bell for notifications to be the first to hear what is going on. My name is Megan Becker, a local Realtor. This is Keaton Kirkwood with Kirkwood Brennan Mortgages, one of the top mortgage brokers in all of Canada and who I trust most with anything mortgage related. Our team gets calls every day from people looking to make moves within the greater Vancouver area. So if you're considering making a move, please give me a call. All my info is in the description box below. And today I'm excited to have Keaton here with me. We're going to talk, we're working with some buyers right now. And we're looking forward to sharing just some real life examples and some insights that could really help you guys considering making moves right now. So welcome, Keaton.
Hey, how's it going?
Awesome. Excited to have you here. And like I said, the September numbers are out and things have just continued kind of on a slower trend here, but it's definitely giving away to a lot of opportunities right now. And I know you and I are both working with a lot of people in the market, but maybe just a quick little insight. Tell everyone what from your perspective, what you see is going on in the market right now.
So often on the financing side, we will see the increase in attention or energy or desire in the real estate market before the market sees it, in the sense that as a realtor, you're seeing pending transactions, listings, and solds. Before that happens, buyers have to think about buying, decide they want to buy, typically go through the gauntlet of getting pre-qualified, then they begin to write offers. So we're seeing a substantial uptick in the number of inquiries we're seeing. As an example, while we've been on the call, I've had the last 20 minutes, we were chatting before we went online. I've had 3 people reach out to our website, and I don't do any paid advertising. So this is just organic stuff. There's a lot more attention leading to financial conversations and financing, which then leads to pre-qualifications, which then leads to searching. So realistically, like ATB, the Alberta Treasury Branch, so one of like the coast capital of Alberta, essentially is predicting 1.5% in cuts in the next year and a bit. CIBC, I believe, is predicting 2% in cuts. I saw another study that just came out. They were predicting 1.25% in cuts by January. I think that we are about to see the top blow off, in a sense, because there's so much pent up demand of people waiting for rates to drop. Well, rates are dropping, and they are dropping fast. So it's going to be interesting to see. I know that we've been working very long days just to kind of stay ahead of everything. Scott and I, my business partner, we have a policy: done is better than tomorrow. So we always make sure that we get everything done every day. But the demand is certainly starting to pick up. I don't think the market's feeling it yet, but it's close.
Yeah. So. Yeah, it's interesting because I'm having conversations with people that they don't need to purchase right now, but they need to purchase in, say, the next year to maybe 2 years as a time frame, and the topic of conversation comes up of timing the market, of wanting to get it when interest rates are low and prices are low. But as you and I both know, and this is the conversation I have with them is, do you remember what happened back in 21 and 22? Is that by the time that happens, prices are already on a rise because there's so much competition. So I'd love to hear your insight on the whole kind of myth of timing the real estate market, of trying to get best of both worlds, low rates and low prices.
My specialty, what makes us different, is we specialize with real estate investors and tax strategies. Like, we're licensed in multiple provinces. Even full-time real estate investors don't time the market well. So my suggestion is, if you're buying your first home or you're going to sell and buy, like, it's nuanced. If you're selling and buying, if you sell low but buy low, if you're purchasing a more expensive property than you're selling, you actually come out ahead. So one of the things we see, that the moment we get into the actual numbers, clients are like, oh my God, thank you, you've just saved me $30,000, is if you're selling $1 million home to buy a $1.5 million home, you don't want the market to go up before you do that. And cover your ears for a minute, Megan. The realtor fees are bigger when you sell. You pay more property transfer tax. You have to carry more debt typically. If there aren't any tax implications in the sale, you're selling for a higher price. So the answer is very individual, but generally speaking, like timing the market's bullshit. And what I mean by that is, yes, if you are fortunate enough to get lucky or you are smart enough to be skilled to nail that, sure, it's perfect. Wouldn't we all love to buy right after the stock market crashes? We all would go back in time and invest in 2008. But that's not the real world, and that happens periodically. So we actually have a calculator on our website. If anyone wants it, if you want, you can link it in the chat, Megan. At kbmortgages.ca, there's a tool on the top, mortgage calculator. If you click the comparison tool, you can run up to 4 scenarios at the same time. And this is what I use to factually show clients, what if you buy at a lower rate? What is the savings, and how much does the property price need to go up to equal those savings? It is a razor thin margin. Often rates going down 1%. When you're buying in Vancouver, as an example, remember that you're only getting a mortgage for like 2 to 5 years for the rate you get. Whereas what the price you pay is forever. So you're going to have that mortgage debt likely for 30 years or 25 years. So a very small increase in price will offset a relatively large drop in interest rates. So I'm not saying take my word on it. You can go to our site or find other mortgage calculators, but we have a tool specifically for this to avoid the sales woo-woo that people like to use and to just give the actual data. Where it's like, hey, if rates go down 1%, but that property goes from $1 million to $1 million and 20,000, you break even or whatever it may be. So I believe that's the best way to make the decision. But I can tell you anecdotally from experience, it's a much smaller gap than most people think. And it is very self-serving because it usually leads to, oh shit, I should just buy now. Because that's what the data tends to say.
Yeah, it's really tough. And I always have the conversation with clients. I start with, what is your motivation? And you should be buying for a bigger goal than just getting into the market at the exact right time period. It should be, family goals, financial goals, real estate goals, whatever that is. And then I always remind people, real estate, it's a long game. It's not, we're not looking to sell and make a profit in the next year to 2 years. I think like 8 to 10 years at minimal, you want to be in the market. And so that whole saying of time in the market is better than timing the market. But you had mentioned rates there. And so I know there's not a black and white, variable versus fixed rule, but what are some
I've got a black and white answer for rates right now.
I would love to hear your insight on that.
And normally I'm a professional fence sitter. Like I very much, my goal is to give clients their options. And I'm like, Megan, if you're my client, you've got one job, and that is to make the decision. My job is to get you the information in an accurate way that makes sense so you can weigh the pros and cons, and I'll guide you through that. Right now, though, I believe there's 2 groups of people. There are those that believe rates will not drop or they will go up, in which case take a fix, go for it. If you believe rates are dropping, let's say you want to time the market, you want to wait for rates to drop, there's a simple solution. Take an adjustable rate mortgage. It's not about will it be cheaper over the next 1, 2, 3, or 4 years. It's about as rates drop, you can convert to a fixed mortgage at any time in the future without any costs or fees. Certain lenders allow you to immediately convert into a 3, 4, or 5-year fix. So you get even more options. So my viewpoint is, if you believe rates are likely to drop, which most of the analysts and the bank reps or like the economists are saying, and honestly, they're between fortune tellers and weathermen. So I don't know if I'd really believe them, but there's a lot of data that says rates are going to drop quite quickly, and they are dropping. Take a variable or an adjustable rate mortgage and procrastinate the decision to lock in. It's not about is variable or adjustable rate cheaper over the next 5 years. It's about you can decide to lock that product in at any point in time in a month, 2 months, 6 months. So as long as rates are dropping, you just sit tight. And then if they hit a level where you're happy that, oh, I would have bought this house for $1 million if rates were 3.5%. Well, buy it for $1 million. Yes, theoretically, maybe you're going to pay 5.25 or 5.5% today in an adjustable rate or a variable rate. But the key thing here is, do you have the reasonable expectation rates will drop? I think most people right now are believing yes. Most professionals are believing yes. The government's certainly saying yes. And the US as well, not just Canada. You simply delay that decision that, oh, hey, rates did hit 3.5. Yes, I got to buy the home I wanted for $1 million. I'll lock in now if that's the case. You need to make sure if rates don't drop, you can live with what you're getting. But the flip side is, like, I've done this for 10 years. There's nothing worse than you are subject free offer number 9 out of 20 offers.
Yeah.
Very quickly, you go from the home you want to the home you can get. I hate that market. I hope it does not go back. It is awful for everybody except for the super listing agents. They just print money and sit in Mexico or whatever they do. But everybody else, like, it sucks. So it's much better to get the home you want at a slightly higher interest rate than you would like, but for a fair price, than to get to the point where it's like there's 20 offers, get in line. You know, you got to be famous to get into the nightclub.
Yeah. Yeah. And that's what I've been telling people. I mean, you know, you always hear every realtor says it's always a good time to buy, but in reality, if you are needing to move in the next year, now is that time before that market hits up. Nobody wants, exactly like you said, nobody wants to be competing of, you know, multiple like 10, 20, 30, 40, 50 multiple offers in a situation that it's so stressful, and you can save yourself a lot getting in now. It seems like it's going to be the perfect everything coming together in that perfect storm over the next couple months to really get you what you want in the market right now.
In 2021, before things slowed down, we had a client that wrote 20 subject-free offers before they got a home, like an offer accepted. It's awful. And I genuinely, the realtor prepared over 20 offers. They must have seen 50 properties. We had to like 911 financing over and over and over. It's awful. I don't hope it comes back, but it's fundamentally the supply and demand imbalance of the BC market has not changed. The demand has diminished temporarily due to higher rates, but the number of families looking for shelter, essentially, the relationship of rent versus owning, none of those things have fundamentally changed. So I think the moment that the psychological piece of rates are high goes away, the demand's going to be back. Like the only variable that I can't personally speak to is that the cost of living's gone up, like groceries and whatnot. But sure, the people that have the $900 rent for that 1,600 square foot condo in Granville, they're not moving.
Yeah.
But everybody else is probably still thinking about it. So, you know, I don't know the future, but I think that they're certainly going to be printing a lot of money, and, you know, real estate being a hard asset, like, you know, it's a reasonable choice to say the least, but I don't know the future either. So.
Exactly. I would love to hear your thoughts on this situation, because I've had a few conversations with clients over the last little bit, and they're just figuring out how much money to put down versus how much to mortgage. And one conversation with a client, he's like, I could pay cash for this, or there is the opportunity I could mortgage, you know, maybe put a 50% down payment. Another client who it's kind of similar ratios and just weighing out the pros and cons of each. But I'd love how you kind of walk through people and things to consider on like how much do you put down versus how much do you mortgage.
Yeah, for sure. So the first thing you have to do is screw what the bank says. Go look at your bank statements for the last 3 months. And this sucks, by the way. Like, we'd all rather go to the dentist than do this, but it's the most important thing you can do to not be house poor.
Yeah.
Go through your bank statements for the last 3 months. Look at essentially the amount of money coming in, and look at all the money going out that is not rent or your current home.
Right.
And essentially what that's going to figure out is the maximum amount of money you have. So basically, let's say you bring in 10,000, you know, your rent's $4,000, and then you spend 3,000 on life. Just, I'm making up numbers. So we know that 10 minus 3 is 7. So you've got $7,000 because your rent's going to disappear when you buy a home, maximum to buy a house. Now, that's not saving for retirement. That's not doing anything else, but that's your theoretical max. And then we can have a conversation off of how much of a buffer would you like. But that allows us to figure out what the maximum you could afford is, at least in a lifestyle perspective, without changing things drastically. Then we consider what the lender will give you. And then we consider, where are you at in life? Like, what are your financial goals? Lower mortgage payments have the benefit. So let's say you put more down. It has the benefit of lower payments, which means you could invest more. So theoretically, that's good. But having a larger mortgage and having more money available to then invest, let's say max your tax-free savings account, is a greater good. But so there's this kind of calculus that goes into it of what is the highest and best use of your money within the threshold of what are you comfortable to afford. we can get into even more, like, as an example, the individual that could buy in cash. One of the things we could explore is called a debt swap. Theoretically, let's say they want to put 50% down, but they have the ability to buy in cash. Like, let's just say they've got $1 million in inheritance or whatever it is, sold a place. Buy in cash, we trigger a refinance day one, they get $500,000 back. They now have $500,000 in their hand, identical outcome as if they put 50% down. But the mortgage is linked to the $500,000 in their bank account. They then go invest that in a non-registered way. They go buy real estate, they invest in the stock market, whatever it may be. Please use professional guidance on this. I'm not telling you to just go YOLO. But if you invest it in a non-registered way and you meet certain rules, you get to write off the interest on that $500,000. Well, $500,000 at 5% interest, that's $25,000 in interest a year. If that's a tax deduction, simple math at a 50% tax bracket, that's $12,500 every year you get back that you can then further invest or use to pay off the debt.
Yeah.
So I think that it's important that it's kind of like dating. There's not one solution for everybody. You got to find the right fit for yourself.
Yeah.
And that depends on your lifestyle, your goals, your age, your risk tolerance. So, my advice is that whoever's doing your financing should be having these conversations with you. It's not like, I tell every client, I will not get you the lowest rate. And it's not that I want you to pay a higher rate. It's just that's some janky online, puppy mill of a mortgage outlet. Because at the end of the day, they work for substantially less money and they do high volume.
Yeah.
The value we bring is still getting a fair and competitive rate, but it's all of the nuances in the planning to figure out what's the best structure for you.
Yeah.
And really, that's what we do to be different. But that's the type of conversation your professional should be having. It's not just, do you want fixed or variable? This is low, good luck, bye. But understanding what's going on in your life, your needs, your desires, what's going to change, and then tailoring the structure of everything around that. The problem is it's not easy. That's why a lot of people don't do it, is that understanding these, working with accountants for these different tax strategies, having the conversation of lifestyle, knowing someone's goals, like, oh, hey, my family's from England, I might move in 3 years. Okay, well, we don't want a 5-year fixed. It runs the risk that you scare the business away, because there are some clients where we do that business or bank statement audit, and they realize, holy shit, Megan, I can't afford this, and they don't buy. And I'm happy when that happens, because yes, it sucks that they can't buy and it sucks that they can't afford it, but it's a hell of a lot better to know that before you get the keys to your new home.
Exactly.
So I'm rambling now.
No, I totally agree with that. But it is, and that's one of the reasons why I was love having people talk to you, even if it's a second opinion, because not all mortgage professionals are created equally. And I always tell people that it's not just about the rate. It's not just about, getting the lowest rate, but it's having someone that understands your whole, your goals and can find the best product that's going to fit that. And so I really appreciate how you take that time, and it really is about the best interest in the client there. Last question before we dive into, sorry, go ahead.
I was going to say, we actually have a mandate from the province as brokers, as actual mortgage brokers. So not mortgage specialists or branch people, but brokers. We have a mandate from the province to put the client's interest first above everyone else, ourselves, the realtor, the bank.
Yeah.
And I think that the bar is pretty low for some people. Hey, there's a lot of great people out there, but I'm a believer that the actual bar of the fiduciary responsibility is what we have. It's very high. So we try very hard to make sure that we understand those needs and those wants, and we get the humanity of the real estate, not just the numbers. And then we go through options and benefits and different ways to structure things, because that's the only way as a consumer someone can make an informed decision, is for someone to show those options. And kind of like a Sherpa, it's our job to take the weight and the time and the burden off of that and be like, hey, here's easy to digest information on the decision you're facing and your options.
Yeah.
But, I get frustrated because not everybody focuses on that. It's often just very transactional.
Yeah, which is definitely unfortunate. I'd love for you to share a little bit more because I am, and this market, for me, anyways, has led to a lot of first-time buyers wanting to come in, and rates are dropping, and they're seeing a little bit more inventory right now, and maybe just the time in their life. But I'm sitting down with quite a few first-time buyers, which is really exciting. The opportunity to get into the Vancouver real estate market. But I'd love for you to quickly share just some of the incentives that to make sure that first-time buyers know that they are available to take advantage of.
For sure. So from the wealth accumulation side, there's the ability to withdraw. I believe it's up to 60,000 in RSPs per first-time home buyer. Like, so if there's a husband and wife or whoever it may be, two buyers, you can pull up to double that, so 120,000. There's the first-time home buyer savings account, which you should open ASAP because the limit is set off of when you open it. So if you open it this year, you get an extra 8,000 to the total limit versus if you open it January 1st next year. So the sooner you do that, the better, because it's kind of like a tax-free savings account. So that's the wealth accumulation side. When you buy your first home, you get a small tax credit that you have to file. So just if you're watching this, write a little note, talk to accountant or TurboTax or whoever, get that tax credit, because it's one of the most common things. We work with a lot of clients where we get their tax returns. We're like, hey, you didn't do this. And they're like, what? And it's free money. It's like $700-800 usually in your pocket. So that's the tax filing side. There's the ability to avoid property transfer tax if you buy a home that's eligible, which is in kind of the ideally $835,000 or less. That allows you to buy the property transfer tax of the first 500,000. So it saves you about 10,000. And there's what's called a sliding scale between 835 and 860. I won't get into specifics of it, but if you buy under 860, you pay less property transfer tax. If you buy 860 or higher, you pay all the property transfer tax. So it saves you about 10,000 ideally.
Yeah.
And then there's one last benefit that I think is kind of important to know, which is they've changed the rules for if you put less than 20% down, they've made it so the first-time home buyers can take a 30-year mortgage amortization, which I was not happy to see. There's a lot of brokers and realtors singing from the rooftops, but hey, at the end of the day, yes, in theory, it's great. But the problem is that there's a market with a huge supply and demand imbalance. All they've done is allow people to pay more. So I think that there's a window. This rule kicks in December. There's going to be a window where it's new, and the early adopters, in a sense, will have an advantage. They will be able to either pay less because the market won't have shifted yet and take the longer amortization with lower payments, or they'll be able to buy something they couldn't otherwise buy. The problem is after 3, 4, 5, 6 months, everybody's doing it. What does it do? It pushes prices up. And then the realtors, the brokers, the government, the existing homeowners win because prices went up a little bit. But at that point, all of the first-time home buyers that can now use 30-year amortizations, which increases the cost of the loan by 20%, by the way, like not all good. But at that point, it's the new norm. Because Megan, one thing that I know you and I have seen year after year in the Vancouver market, most buyers are spending the maximum of what they can spend because it's a tough market and most people are trying to claw their way in. All they're doing is raising the maximum, which is going to raise what people spend. So I think for those that act quickly, there's an advantage. Sadly, in a year, I think there's going to be no advantage because that's just the new norm. Everybody will spend that little bit extra.
Yeah, the only area that I liked it for is the families, couple with a couple kids that they need to get out of their condo and they need a little bit of ease in the payments. But yeah, 30 years is kind of scary when you look at it.
The problem is that likely it just means that a pool of buyers will be able to spend more.
Yeah.
Well, if the market gets back to multiple offers, which I hate to say this, but I think it will. If let's say you've got 20 people that want to write an offer, anyone who puts 20% down already gets a 30-year amortization, but we'll leave that out. Let's just say a third of those buyers are first-time home buyers and they can all spend more. Well, the moment they're in multiple offers, what do? They throw their biggest offer at it. All it does is push prices up, and then you're not getting lower payments because yes, you get lower payments, but you're going to your maximum. So you get a larger amount of debt because you're paying more. And you end up with the same payment, larger amount of debt, and you paid more for the house.
Yeah.
So once again, though, the good news is that this rule is new. So there will be a window where it takes that extra buying power to kind of saturate into the market and slowly increase prices. So, I don't know if it's going to be 2 months, 6 months, a year, but there is an opportunity there. But I wrote a big article and went through the analysis on this. Sadly, in the long term, I don't really think it's a win. More option to spend more money, but there's not really an alternative in the BC market. So
yeah, it's interesting. It'll be interesting to see for sure. But I really appreciate your time. I think we'll wrap it up there. And as always, if you guys are considering making moves, please reach out. All my info is in the description box below. I will also link that calculator that Keaton talked about, so you can do a side-by-side comparison. I've sat down with clients and ran through that. I'll link Keaton's info in the description box below, and look forward to chatting with you all next week.